Chinese authorities recently announced a bunch of different measures to boost the Chinese economy and markets. Because of the massive size of this stimulus, but more importantly, the impact it has already had on markets, people have nicknamed it the bazooka stimulus. It includes interest rate cuts, easing restrictions on home buying, and liquidity injections to boost the stock market. And indeed, following the announcement, Chinese stocks surged by a rapid 40%, making this the most rapid rise in Chinese stock prices in the last 20 years of price history. But as we'll see in this video, this isn't the first announcement that Chinese authorities have come forward with. We've seen multiple over the last couple of years, and while all of them led to temporary stock market excitement, none of them managed to revise the Chinese economy or stock market. The question is, was this one actually any different? We can see that some of the gains from the spectacular melt-up have already been retraced, leading many investors to question whether this bazooka stimulus actually lives up to its name and whether it can lead to a sustained economic and stock market recovery in China, or whether this is just a big fat short squeeze that's just going to be deflating from here on. We've only seen these types of such rapid returns a handful of times in Chinese stock market history. Here, we've put red dots at all of the moments where the Chinese stock market returned over 15% in 5 weeks, which is what we've seen recently. Now, we can see that in many of these cases, these very quick returns were quickly faded in the weeks that followed. But in a few of these instances, these bouts of strength were followed by more bouts of strength. So how do we know which one it's going to be this time around? In order to understand the durability of a rally, we first need to understand what has been driving this rally in the first place. And the evidence is so far quite clear. The move up in stocks has been driven by rising valuations. This chart shows us Chinese stock market valuations over time, what's known as the PE ratio. This is basically how much investors are paying for the profits of these firms. So giving an idea of how expensive these stocks are. And we can see that Chinese stocks just went from one of the most undervalued levels in history, comparable to the 2008 financial crisis, back to slightly more normal levels. And this reversion to the mean in valuations is about a 40% jump in the PE ratio. That means most of the recent appreciation in Chinese stocks are a result of valuations increasing, not an increase in actual company profits. Stock market earnings in China have been on a steady decline since 2018. A large number of different factors have contributed to this, like aging demographics, a declining housing market, and low Chinese consumer confidence. And they've yet to really pick up, despite the measures that Chinese authorities have already taken over the last couple of years. We've seen a little bit of a rise in earnings, but definitely not a 40% move up. If the rally in Chinese stocks were to continue higher, we would have to see the stock market earnings begin to move higher just like they were in the early 2000s. So in other words, in order for the Chinese stock market to continue moving higher, this bazooka stimulus actually needs to make the Chinese economy boom again, just like it was booming in the early 2000s. Now, maybe the fact that this rally is so exceptionally strong, a lot stronger than anything we've seen over the last couple of years, means that investors actually believe that this bazooka stimulus is actually going to yield good results. Or maybe not. Many analysts have recently argued that this recent stimulus announcement is more of a bazooka for the stock market rather than the Chinese economy. Indeed, the two big measures that were announced for the Chinese economy were a 20 basis point rate cut and easing restrictions on home buying. These are two policies that are targeted to the real economy, but they're both things that the Chinese authorities have already announced multiple times throughout 2024. The People's Bank of China has cut its interest rate by 20 basis points many times this year, and that hasn't done much to revive the economy. And easing restrictions on home buying is also something that they've done before. The measures that were new in this bazooka announcement was a $70 billion swap facility to support stock purchases and a $42 billion refinancing facility to support corporate share buybacks. And indeed, both of these new measures are primarily targeted at the stock market rather than directly addressing China's core economic problems, like low consumer confidence and the ongoing property crisis. Now, this may have been completely intentional from the Chinese authorities. The Chinese stock market has been suffering from very low valuations, which can disincentivize foreign investments in China. Authorities may want to be showing that they're supporting the Chinese stock market to stimulate foreign investment. Also, a rising stock market can indirectly have a positive impact on Chinese consumer confidence and maybe lead to higher levels of spending. After all, if we can't fix the housing market, let's just prop up the stock market. Now, whether or not these measures can actually lead to a proper economic recovery in China, that remains to be seen. This chart, for example, is not pointing in that direction. This is something called the M1 money supply growth in China, and you can see that if we shift this chart forward, it gives a good indication of what trend you can expect from the Chinese stock market. That's because as the money supply is growing, people are borrowing more money and spending it, which stimulates economic growth. That can lead to a durable recovery in Chinese stocks, and you get the opposite effect when money supply growth is low, or worse, when it's negative. That means there's very few people borrowing, and so the economy is unlikely to grow. And that's currently the case for the money supply growth in China. It is in the deepest contraction of the last 20 years, which for now isn't really hinting at a durable recovery for the Chinese economy. Something similar happened in 2015 when Chinese stocks saw a spectacular melt-up, despite the fact that the money supply was still very low. Now, while any one stimulus announcement hasn't yet reignited money supply growth in China, we do see that there's a general tendency for authorities in China to try and stimulate the economy and get it back on track. And it's very likely that they'll eventually succeed in doing so. If it happens quickly enough, it's possible that the money supply actually ends up catching up to the stock market, which is actually what happened right here. Chinese stocks had already rallied quite substantially before the money supply growth actually began to move up and led to a sustained recovery. Something that investors should also keep in mind is China's strong potential as a portfolio diversifier. Over the last decade, China's stock market has only had a 28% correlation to the US stock market. This is incredibly low compared to the rest of the major Asian stock markets. This is likely a result of the huge differences between the Chinese and the US economy. Now, that effectively means that Chinese stocks can go up, even if the US stock market is experiencing turbulence. This is something that isn't true for the vast majority of global stock indices. Don't waste your time and come join us at Capital.com.